Hello, everyone. It's Sid here from Fundamental Research. Our guest today is Nolan Peterson, the CEO of World Copper Limited. World Copper has two advanced stage copper assets in two attractive jurisdictions, one in Chile and one in Arizona. Based on preliminary economic assessments on both assets, the combined after-tax N plus NPV at 8% of both assets is over $1 billion US at $3 per pound copper. World Copper is trading at a market cap of just $30 million US. So the agenda for today is I'll kick off the call with our thoughts on copper and how and when to re-enter the market. And Nolan will take over from there and talk to us about his assets, upcoming catalysts, and strategies to develop these assets. For listeners, you can either wait till the end to ask questions. If you have questions during the presentation, feel free to type them in and we'll try to respond to them. Here are some key disclaimers. Please take a moment. Okay, so let's get started. Copper prices are down 15% in the past 2 months and is currently under $4 a pound. The S&P 500 is also down 15% in the past 2 months. Now, this is not a coincidence. This demand for copper is directly proportional to global GDP growth. And that's why copper is also known as Dr. Copper, or the metal with the PhD in economics. Rising rates and slower GDP growth forecasts are driving copper prices and equity markets lower. As shown here, GDP growth is expected to slow in all of the main regions in the world. This will have a material impact on demand for base metals. Lower demand is expected to move the copper market to a surplus this year. This is another reason for lower prices. The S&P 500 is trading at about 18 times earnings versus the historical average of 16 times. So we believe there is room for another 10 to 15% fall in the S&P 500. Copper prices could also fall by the same amount. Despite our weaker near-term outlook, we have a positive long-term outlook for copper, and this chart explains the reason. Electric vehicles, or EVs, are expected to be the biggest long-term demand driver for copper. Everyone knows about cobalt, nickel, graphite, and lithium's usage in EVs, but an EV uses more copper than any of these other four metals. Each vehicle uses about 80 kilograms of copper versus 10 to 50 kilograms by the other metals. EV sales are expected to increase from 6 million per year currently to 30 million per year by the end of this decade. And EVs currently account for less than 1% of total demand for copper. However, we expect copper demand to account for almost 9% of EV or total demand by 2030. Including these additional demand forecasts from EVs, we're expecting copper demand to grow at 3.5% per year over the next decade versus 2.8% historically. Looking at both demand and supply, we're expecting significant supply deficits in the latter half of this decade for copper, which we believe should keep prices well above the historic average. We believe that most of the large undeveloped copper projects have break-even prices higher than $2.50 per pound. As a result, copper prices need to be at least 20% higher, that's $3 per pound and higher, to incentivize copper developers. We believe rising production costs and declining grades should keep prices well above the $3 per pound floor. Finally, to secure long-term stable and secure supply, we believe majors and mid-tier miners will be looking for fundamentally solid juniors with attractive assets in safe jurisdictions, and we believe World Copper is well positioned. Although a near-term outlook for copper and equity markets are weak, we believe the recent correction will prompt larger or mid-tier miners to pursue M&A opportunities. Therefore, in this market, we believe being highly selective and exposing yourselves to advanced stage assets is a better strategy. With that, I would like to welcome Nolan Peterson, the CEO of World Copper. Nolan, you'll be able to share your screen in a second. Please go ahead when you're ready, Nolan.
Thanks, Sid, and thank you everybody for joining me today. The markets are tough right now for everybody. I know very well how everyone's feeling. But as Sid said, it's very important to invest in companies that are going to be the first ones to respond and bounce back when the market does turn. This is my opinion. The more speculative mining plays or more speculative plays in general, but especially in mining, people are not going to be eager to take on that risk immediately at the first whiff of a recovery. They're going to be looking for long-term value. Now, for World Copper, we are a junior mining company that has established assets, both of them, Zonia and Escalones, as you can see here, Escalones in Chile and Zonia in Arizona, are, as Sid mentioned, in prime mining jurisdictions, Chile and Arizona, for copper. They both have at an advanced stage of exploration and an early stage of development, or advanced as however you may want to call it. They both have 43-101 resource statements, and they both have 43-101 preliminary economic assessments. So they have demonstrated economic value, which I think is very important for when an investor is looking at where am I going to save or store my money? What am I going to invest in these tumultuous times that is going to benefit when things turn around? And why is World Copper down and being pressured is because we've flown under the radar. We've only been publicly traded for the last year. We've done a lot of our work kind of in the background or quietly. We put out some amazing news, but we're still building our awareness in the market through conversations like this or with other shareholders one-on-one or potential shareholders, and really building that awareness and pushing the story out there so that people understand it. I won't talk too much about the management, so I'll just focus in on the assets as a key theme. Both of these projects, Escalones and Zonia, are oxide projects. Together, they have 4 billion pounds of copper oxide in the ground. Copper oxide is a much more attractive project for developing compared to copper sulfides, which make up a lot of the larger projects out there in the market. Oxides tend to be lower cost, so hundreds of millions instead of billions of dollars to develop, lower operating costs, so higher margins, higher profitability, and they're easier to permit because they're cleaner and greener. These, I think, will become advantages for projects of this nature as the market progresses and as we trend towards copper's role growing for electrification and decarbonization. And as Sid mentioned, we're trading at about $30 million US market cap, despite together 2.3 billion in after-tax NPV for both of these assets at $4 copper. So we're trading at over a 98% discount to NPV. And it's important to note as well that you may follow other projects that have a $2 billion NPV and you think, oh, that's not so great. Those projects cost $2, $3, $4 billion to build. To unlock the $2.3 billion value for both of these assets is $700 million or less in initial capital. Very significant difference. Our projects are in this phase, the feasibility development startup phase, which for unfortunately is called the orphan period. But this is where the last opportunity for investors to get in at a low risk level before institutional investors and major shareholders come in and snatch up all the value. So take comfort in knowing if you invest in World Copper, you are past the initial discovery phase, the high risk phase. And this is exactly what I was speaking to when I was talking about what are the companies you want to look for that will weather the storm and come out of the gate of the recession and have the greatest upside. And now these are the companies that have established value and are not still looking for something. Sid talked about copper demand, but I want to emphasize, in the near term, there will be surpluses, very minor compared to the amount of copper used. We're talking about 300,000 tons when we're using about 25 million tons a year globally. So we expect significant gaps to start to form, and not just we, this is Goldman Sachs and other analysts, including Sid himself, starting in 2024, 2025, gaps forming that fundamentally are structural gaps. Demand will always be increasing, and yet supply is actually dropping, even with new mines coming online. So I don't want to take up too much time and get too technical. I want to emphasize Escalones is 25,000 meters of drilling in this orange circle here. We also just finished a program this year or a couple of weeks ago, actually, that gives us the potential to double this resource in size. Escalones is the largest copper oxide project in development in Chile right now. Again, I mentioned these projects tend to be smaller oxide projects. They're near surface. They've all been mined up. Historically, we happen to have the largest copper oxide project because the previous holders completely did not understand the potential for the deposit. And you can see we have a fairly high grade for the large scale deposits. And that's what gives us a very attractive economic prospect. Escalones is our flagship, has a post-tax NPV of $1.5 billion at 360 and a 46% internal rate of return, an initial capital of only 438 million. For investors, I'd like to point to this slide. This is our market capitalization and price versus NPV ratio. We're currently trading at about a 98% discount. Other projects that are at the same stage of development, PEA, or in the same jurisdiction, if we were, for example, at the same as McEwen Mining, Los Azules, we'd be at 5x from today. And yet we are 5 times less initial capital than Los Azules. Another project that we are peer group with is another oxide project called Marimaca. We are twice the NPV of Marimaca, but they are 10 times our market cap and 20 times our P to NAV. And it really comes down to awareness and support in the market, which is what we are looking for and building towards right now. We also have an amazing project in Arizona, which is the Zonia project. This is a brownfield asset. You can see it's already been pre-stripped, already a leach pad from former production, 50,000 meters of drilling, all on private patented land. That makes this project very advanceable, can be put into production in 3 to 4 years and start to hit that gap that we just spoke about of low supply and benefit from higher prices. A PEA was done on this 4 years ago at 200 million initial capital. After-tax NPV at $4 copper is 450 million. After-tax first-year free cash flow of 150 million. If there's a higher copper price to support even more improvements in this valuation, you can see why we are pushing this project very aggressively. Together, well, first of all, we'll be doing Zonia PEA update this year, feasibility study next year, potentially in operations by 2025. We use the cash flow to advance Escalones in conjunction. So that's the World Copper story. I'm happy to answer any questions from Sid or others. Hope you'll take a look at us further, and interested in any follow-ups, please feel free to reach out to me as well.
Thank you so much, Nolan. We can now
Thank you, Sid.
open the call to a Q&A. Listeners, if you have any questions, please feel free to type them in, or you can click on the raise hand option and I can unmute you. So Nolan, while I compile questions, maybe you can I want to try to try and pick your brain on this. How do juniors typically survive in these tough market conditions? Now, I know that World Copper, yourself, you raised close to $6 million and sitting on a lot of cash, so you're fine. But how do juniors typically, survive this situation, these kind of market conditions?
Yeah, so it's kind of largely on whether you enter the conditions in a good, healthy position after a recent raise, or in advance of a drill program or something, or if you enter it kind of weaker and needing to raise money. That can really depend on how much dilution you have to pick up. Most junior companies don't operate with a substantial treasury because we're advancing from objective to objective and we only raise as much as we need. And we also are very optimistic about the future at all times. That's why we're in the space and why our investors are as well. So yeah, it really comes down to really pulling back on advancing the programs until the market will support it. And by that, I mean, you can put out the best news in the world, but sometimes it just gets swallowed up in a sea of negative sentiment that exists in the market. So that's something you have to be watching out for. You have to time your activities very correctly, which is what we are doing, and also look for advancing the projects down paths that don't take a lot of money, but do unlock a lot of value. So for us with World Copper, for example, both of our projects, as I mentioned, are at a stage where we can advance through desktop work, through engineering work, de-risking, making the projects better, through understanding how we're going to advance them. A lot of juniors are unfortunately not in a good situation where they don't really have an asset. They have a concept or a prospect, and it's really tough for them to continue to work if the market isn't supportive of drilling or anything like that.
Okay. Now you mentioned that one of your, or you mentioned previously, is one of your strategies, or one of the strategies of most juniors is to kind of find a JV partner once you're advanced enough. What are your initiatives on that? Have you started doing JV discussions, or what's your ideal timing for this?
Yeah, so we have started discussions. We put out the news on our PEA for Escalones just 4 months ago. We also just put out the news when we merged with Cardero and Zonia in January. So really, we are very early in those discussions. But despite that, on both projects in the last few months, I've signed a lot of non-disclosure agreements, had a lot of discussions about partnerships and JVs and what we can do. It's important to understand that you can have the best story in the world, but these guys still take their time in doing a review and due diligence, and they move at their own pace. And that's it can take quite a while to do it. We just signed last week, actually, a royalty agreement with a company that's looking to pick up a royalty on the Zonia project in Arizona. They believe it's very advanceable, and of course, royalty companies are looking for prime opportunities, and Zonia was one for them. So that was one we were happy to engage in, unlocked a lot of value at an early stage in the company, monetized basically something that would take years to do in a normal situation. So those are the types of deals that are available to us because we have established assets, and we are always in discussions on those. And I wouldn't be surprised if something came out in the near future on those as well.
So Zonia's attracted the royalty companies. Sonia is much smaller than say Escalones. What kind of minor or will you attract? Are you looking for a mid-tier producer or an advanced stage junior, or who is your
Yeah,
ideal partner there?
it's ironic you asked that, Sid. There's a lot of projects and companies that are in the market, well supported right now, that have basically come to me to discuss the opportunities of having a real asset like Zonia in their portfolio to advance. It's tough to find projects like this that are near to production in an attractive jurisdiction with a compelling path to production because they're easier to permit. So that's something that we are, an angle that we are starting to realize and pushing forward very hard on. So yeah, juniors that are, doing very well in the market, have really strong access to capital, strong supportive shareholders, major strategic shareholders like big names perhaps are of interest to us, as well as juniors that are in production, maybe not in the US, they want a more of an Americas focus. Maybe they're in, other parts of the world. They see that how quickly they can secure copper production and supply. They're in discussions with us. So these are the types of companies that are looking for us. It is a fair bit smaller than Escalones, so don't expect a major like a BHP or a Freeport or someone to be interested in Zonia in particular, but there is definitely interest out there from companies that it does suit.
So sorry, I was yeah, okay. So I was just mentioning that you can see from the chart here that the average annual production is 15 million pounds per year. So if you apply $3 to $4 per pound copper, you're looking at 150 to $200 million in revenue.
Yeah, exactly.
Someone who is looking at this asset. Cash cost for the project is $1.46, which is still relatively low if you look at the sector average. But moving on to Escalones, one of the main advantages of Escalones and why it has such attractive economics is its low cash cost of
Yeah.
$1.12. Maybe do you mind giving more clarity to to our viewers here, listeners here? Why is this project? You mentioned why low capex, but why is it low opex, and what makes it more unique than other assets?
Yeah, let me see if I can bring up one of my other presentations here. And this kind of spells it out this is our more full-size presentation. You can find this on our website. It's a quick visual demonstration of the difference between oxides and sulfides. So look at the oxide project and look at the amount of equipment you need to put in place, that's the CapEx, and to operate it. So you have a smaller team, a smaller profile, and just a much easier project to operate and build. Sulfide flotation projects are larger footprint, larger mills, they require more people and more personnel. They require more water. So for example, 4 times as much water in a flotation plant than in an oxide heap leach project. So that requires larger pieces of equipment, more consumables, more reagents for the processing. Then you have to dewater the concentrate. Then you have to ship the concentrate on trucks to a port. Sometimes you have to build the port and operate your own port facility. If you're a very sizable operation, you have to ship it on a boat, usually to overseas markets where it's smelted. You have to pay the smelting costs for that. All of this is it's a much larger project. It's a much more expansive project, has a much larger infrastructure footprint and environmental footprint. And that really is what leads to the cost. So when you look at Escalones with sorry, it's actually $1.19. I think I had a typo on the other presentation. $1.19 per pound. This is not dependent upon a byproduct either. Because we're making grade A copper cathode, we don't rely on a gold, silver, or molybdenum byproduct to kind of artificially lower the copper cost, right? This means that even in a low copper environment, which often means a low gold or molybdenum environment as well, we are still very profitable. We don't get hit by the cost side or the revenue side. So that's the difference. It's just basically less reagents, less mining. You don't have as much of a strip ratio because you're not moving a lot of oxide, which for a sulfide project would be considered waste. And then you're storing that. It's just a much simpler process and leads to lower cash costs.
That's perfect. Talking about your cash position, recent financing puts you in a strong balance sheet. How long will this cash last? When do you have to go back to the market?
Yeah, so we actually used a lot of that cash for a drill program recently, which for Escalones, the one that has the potential to double the resource and size. I'd say we're at a fairly comfortable cash position right now. However, with the way the market is right now, we don't want to, as I mentioned earlier, we don't want to take the risk that we run too low in the market right now and run too tight to the line. So we may do a small raise in the near future that will bring some cash in the bank and basically give us a good solid runway for the next year or so.
Okay, perfect. Nolan, I don't see any more questions. Do you have any final thoughts?
Yeah, I would just say, everybody, as I mentioned at the start, it's been a tough market. Be very selective in what you are investing in, and also be patient too. You can't expect quick returns or strong support for the names that you do decide to invest in today's market. A lot of stocks, including ours, are potentially going to be battered a little bit, but it really look to the upside as we come out of the market. I also want everybody to know that I'm with you every step of the way. I've bought 600,000 shares in World Copper, or 600,000 or so shares in World Copper. Every single share I bought with my own savings and my family's own cash in the open market. I've never been granted or given a share or taken part in any of our financings. I prefer to support my stocks or support my company in the open market. I believe we're significantly undervalued. And I invested, bought as recently as last week, even in the way the market's treating everybody right now. So yeah, take comfort in knowing I'm hand in hand with you. Thank you.
Pleased to hear that, Nolan. Skin in the game is something we always look for when we look at especially evaluating junior resource companies. But thank you so much, Nolan, and everyone on the call for taking time today. A recording will be uploaded on our YouTube channel shortly. Please ensure you subscribe to our channel. Also sign up to be a member of our platform, researchfrc.com. You'll get alerts when we publish new reports. And of course, you'll be able to see our list of top picks, and World Copper is one of our top picks. Thanks again. Wish you all the best and stay safe.
Thank you, Sid, and thank you, everyone.